Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, I've got a very special guest. His name is Lon Welsh, and Lon is the founder of Ironton Capital, Your Castle Real Estate, and First Alliance Title. He has over 20 years of experience in commercial real estate acquisitions and development. And Lon founded Ironton Capital so that busy professionals could find and build a secure, stable financial future through passive, diversified real estate investing, which is just music to my ears, Lon. That's what I think we're all looking for and what our listeners are looking for. So excited to have you on the show. Before we really dig into, the meat of what you do, just step back with us and give us some insight into really who you are and how you ended up where you are today.
Yeah, I worked in corporate finance for a couple of years, went back to grad school to get an MBA at Vanderbilt, and I worked as a strategy consultant for 8 years. And after that, I switched to real estate full time, so I've been doing that for about 23 years now. Most of that, I built a real estate brokerage from scratch called Your Castle Real Estate, which we grew to be the largest independent in Colorado, with about 750 agents. And what was great about that is we'd do 4,000 or 5,000 transactions a year, and about 1,000 of those would usually be investor transactions. So I had a front row seat to watch a lot of transactions here. What do you think is going to work about this? What do you think is not going to work? And then 2 years later, actually get the actual results of how it worked out. So I've done a lot of investing myself, but I've learned as much just from watching all of these thousands of transactions over the decades. And it's been very fantastic to get that experience. I switched over to Ironton full-time a couple of years ago after I sold the brokerage, sold the title company. What I found is I've done hundreds of classes and I've written several books on how to invest actively. And I'd run a class, have 20 people, tell them about how to invest actively. One would say, yeah, great, let's go buy an apartment building. And 19 would say, great, logic is great. I'm too busy to do that. I just don't have time for that. So now I've got a company where I can help the other 19. I'm really excited to do that.
Yeah, I love that. I mean, it just, it makes a ton of sense on the evolution, right? And I mean, there's so many people out there that are great at what they do. They don't want real estate to be a full-time job, which right. I often find myself trying to talk people out of because I've done the single family thing, which is where most people go. I've self-managed those. I know it's a difficult process. And I often tell people don't go buy yourself another job. Right. Do what you do well, leverage your skills, all the time you spent in school and training, et cetera. And, you need diversification in real estate, but, let the experts do it and, let us grow that wealth for you. So it sounds like you're well aligned on that path and strategy. And so, let's dig in today because I want to hear some insights from you. As we were talking about things to discuss, one thing that really stuck out to me and is always near and dear to my heart is, de-risking and thinking about, one of the best ways to do that is through diversification. And you had this concept of kind of these 4 pillars of diversification. So I thought that was a great place to start today, kind of dig in through that framework for folks and help people understand what they should be looking for in their investments. So help us understand what are the 4 pillars of diversification and how should we be looking at our investment decisions?
Yeah, so probably like a lot of your listeners, I started out with a 4-plex and then I bought a 9-unit. And then eventually I got to where I had about 140 residential rentals. And I imagine many of your viewers have something like that. And it's dangerous in a number of different ways. So the 4 pillars of diversification that we like to think about are the asset class, the geography, the strategy, and then the sponsor. And what we can go through all that over, as much time as you want to go into. So the first really is asset class. We think of multifamily or residential as one of those, but there's also, industrial, hospitality, office, and several others. To the extent that you can get a couple of different asset classes in your overall portfolio is going to reduce the amount of risk that you take on throughout the entire business cycle. Just like for your stock portfolio, you wouldn't just have it all in electric utilities or all in technology. You'd want to be in a lot of different industries just to be able to kind of spread out the risk.
So when you think about asset classes, what are the asset classes that you are seeing, that you are focusing on, and kind of talk about why you've focused on those specific asset classes?
So for Ironton's long-term fund, we're usually about 2/3 in multifamily. And the reason why we picked that is if you look over multiple decades of time, multifamily has the lowest returns of all of the asset classes and the least amount of volatility. So usually in a really robust cycle, multifamily will go up some, but not as much as, say, office or industrial will. And during a recession, it'll go down a little bit, but it won't get punished as greatly as retail or some of the other segments. We wanted to get something that was pretty stable, that didn't have a lot of drama to it. And multifamily really fits the bill for that. Everybody needs somewhere to stay. We did like to add in some segments within industrial. If you take a look at the very large warehouses, like 1 million square feet and above, something like a distribution center for like an Amazon or a UPS, those are a little bit overbuilt across the country. But the mid-size ones from like 100,000 to 1 million, that can be divided into, say, 5 tenants, say like 200,000 square feet each. There's a scarcity of that type of product in some markets. So we're trying just to build where there's a supply-demand imbalance that's really, really specific. And then lastly, for hospitality, we really like the extended stay budget component of hospitality. And the reason for that is if you take a look at the extended stay submarket, that's people who stay in a hotel for 7 nights or more. Those comprise about 18% of the room nights in America, and yet only about 10% of the hotel capacity. So there's a big supply-demand imbalance. We like the budget end of the range because that's the most reliably busy thing. So if you think about last fall, 2 hurricanes hit Tampa. They had to transport electrical crews from many states to Florida to rebuild the electrical grid after that hurricane damage. Those guys stayed there for months. And where did they stay? They stayed at extended stay budget hotels. And that's not negotiable. Like if recession, good economy, whatever, like if there's going to be storm damage, visiting nurses, people getting relocated, that's the type of place where they tend to stay. So it's very, stable and reliable.
Gotcha. Yeah. Thanks for the insights. And so then you go from assets to geography, it sounds like.
Yeah. So one of the risk factors I had personally is that all of my 140 units were in the Denver metro area. So for those of you who don't know, in Colorado, there's been 14 different pieces of legislation that passed in the last 3 years that were all anti-landlord, pro-tenant. That's made it a lot tougher for you to be in the residential or multifamily space. So you might be in Tennessee and you're insulated from all that, but there's nothing to say that maybe you have a new governor and legislature next year, and then they decide to copy a lot of the laws from California, New York, and Colorado and make it a much more tenant-friendly state. If all of your eggs are in one basket, all in residential, then you've got a huge amount of legislative exposure there. So that's one reason why geographically being concentrated could really be a big risk factor for you. The second is, in one of our funds, we've got 30 different investments, one of whom is in Tampa, and it did get hit by that hurricane, and it did get flooded last fall. And it was really nice to be able to say 3% of my portfolio is hurricane exposed and 97% isn't. I'm still going to sleep okay tonight. If it was all in Tampa, that would have been a very stressful time.
Yeah, so you brought up a couple of great points there, right? The politics of the environment, of the market you're in, and you brought up kind of exposure to natural disasters, which I think are two of the let's say most, I guess, I don't know, those are two trending topics, I would say, right now, right? I mean, as we continue to see, I think the political environment is extremely important. Where in our strategy, we're very cognizant of that. I used to live in Chicago. I spent a lot of time living in Chicago. I don't invest in Chicago for that reason, the political environment and just the position financially of the city and state. But now I live in Indiana. We love Indiana because of all the things that you said. I mean, there's just, there's no legislation going forward about being, tenant friendly, or tenant friendly sounds bad, but I mean, really what it is, it's kind of anti-landlord, anti-competition. Right. It's, really difficult to operate a business in an environment where they're, controlling your pricing and things. And so, that's one of the reasons why we kind of love the Midwest in those specific parts. But so politics, and it just seems politics are becoming more and more polarizing, right? Where the left is going further left, the right is going further right. And you see some of these cities and states, you mentioned California as an example, kind of leading the way. And then some of these other cities like a Denver kind of taking the lead from them. And you just wonder where, what that does to development and investment, right? I don't think it's going in a positive direction. And then you mentioned natural disasters. Yeah. And you mentioned natural disasters, which, as I follow insurance trends, and you just see that there are more and more $1 billion plus claim events happening really every year. It's like an exponential growth chart when you look at it. And so you think about that exposure, right? If you've got a coastal property, if you're, now wildfires are a big concern, these things that just keep popping up. And so as you kind of take all that in, I mean, what are these markets geographically that you like and that you are focusing on because you're limiting your risk?
And we're trying to get a blend. So we like the Midwest because it's a slow growth, low volatility market. So what we tend to see over time is that prices don't tend to go up or go down a lot. You don't see like lots of supply coming in and the vacancy goes up and the rent growth goes down. It's just stable. And our goal is to hit a lot of singles and doubles and not risk investor principal. And the Midwest is a good place to make that kind of thing happen for all the reasons you just alluded to. And then we blend in a lot of the southeastern, Sun Belt states. We're looking for places that have high employment growth, which drives population growth, and that stimulates a lot of demand for more housing and more warehouse, and then more hospitality over time. What you don't want, kind of like what you were alluding to, is Chicago. Not only is it a difficult political environment, but Chicago and Illinois in general are seeing a slight amount of population erosion over time and job destruction. And it's really hard to, be adding additional units of residential capacity in a market where people are moving out, similar for New York. So those are places that it's just hard to make a business case.
Yeah, absolutely. We're definitely aligned on the geography and where we should be investing. So it makes a ton of sense. So take us down to the next level. What's next on the pillars?
So the next one is strategy. So, there's really, three main ways you can make money in real estate. You can do a buy and hold where you buy a really nice asset in good condition. It's performing great and you're going to pay a market fair price for that. So it's not going to have a high return, but it's not going to have a lot of volatility either. That's not one that we like to do, but if that's of interest to you, there's a lot of REITs, real estate investment trusts, that are efficient ways to get access to that sort of strategy in whatever slice that you want to do, whether it's warehouse or just retail or just Midwest. They slice them up every possible way. The second way to do it is you could do a value add project. And this is where you get a project that the complex has been neglected. The rents are below market because the units just don't look as nice, or maybe the common areas aren't as good, or it's been improperly managed, or the marketing scheme is bad, or it's got a bad online reputation, or probably all the above. And I can talk about a fun case study for that in a minute if you like. That requires more expertise and more risk. It's probably going to take a construction loan, but then commensurately, the returns are a lot greater. And most of my career has been done on the value add side of things. That's what I really like. I'm just doing them on a larger scale now. And then the third strategy is to build something new from scratch. So if you've got a market demand study showing that there's room for extra capacity, you can study the market, figure out exactly what type of asset, what features and benefits it needs to have, and then put something in that's very specific. And that's a glorious thing. On the hospitality side, for example, when we put in extended stay, we're going into markets where there's a real deficit in the amount of supply of extended stay relative to the demand. There may only be two other competitors in this mid-sized market. And if we've got, more or less the same feature set as the two competitors, but we've got a brand new product that looks great, and these two guys are 10 and 20 years old, it's obvious we're going to take a lot of market share really quickly. So those are the two strategies that we tend to focus on the most. Not to say that any one is any better than another. You have to go with the skill set that you've got and that you're comfortable with, but that tends to work out well for us.
Gotcha. So as you look at the different strategies, how are you in the market today? How are you evaluating which strategy to pursue, which opportunity to go after? I mean, what are the things that you're really looking at, or which strategies are you really performing right now?
I'd like to be like 50 to 70% on value add. And the reason for that is that an existing asset generates depreciation right away, and we can pass that along to our investors. So if they are, say, selling an apartment building and they've got a relatively large capital gain, we can give them a lot of first-year depreciation to offset their capital gain. So it gets them the same tax position as if they were in a 1031 deferred exchange, but now they go from being an active person to a passive person, and they're off the treadmill. Mm-hmm. So generating depreciation is very exciting for our investors. And with the tax bill, it's going to be passing here probably shortly. By the time your listeners hear this has probably been decided. It looks like they're going to be accelerating the recognition of depreciation for the next couple of years with this tax package will be a great benefit for all of us that are on this call. And then whatever's left over, we will allocate to new construction. In those situations, we want to work with the sponsor who's really got a lot of experience with that type of construction, and they're going to be responsible for getting it to where it is shovel ready. And we're going to be bringing cash in at that point. So we're not absorbing all the delays of like, well, how long will it take to get permits or environmental reviews or whatever the, red tape is specific to that particular geography.
Yeah, I like that. I mean, your strategy is really directly aligned with how we approach our deals. We started out however many years ago now, about 10 years ago, doing, really focusing on value add projects. And as we moved into, 22, as we saw prices just continue to increase in that time, right? We just saw less of the value add deals penciling out, right? And we saw the market kind of shift and change. And we said, wow, how do we continue to build out a pipeline? And that was really when we began focusing in 2022 on new development, because we found that it was just a great time in the market to where if you could get a project going, if you could make it pencil because you found some unique attributes or a unique way to do kind of a public-private partnership, and get the municipality to help fund some of the project, then you could really provide a great return for investors in a time where a lot of people weren't able to get projects off the ground. And so we've really leaned into new development over the past 3 years now. And it's become, a meaningful part of our pipeline and our portfolio. And so I agree that blend of value add and new development is a great mix, because when we're talking about diversification, right? It's just another great way to diversify on strategy and to provide, a great value add cash flowing asset. I mean, I love value add deals because you mentioned diversification. That's a great, or you mentioned, depreciation, excuse me. That's a great attribute. It's also great to buy an asset that's just 95% occupied and already cash flowing, right? It's great to buy a business that's been there for 30 or 40 years because there's probably a path forward. It's going to continue to do well. So that's great on the value add side. Risk is a lot different than on a new development, right? Where you're starting with land and you're turning that into a big, beautiful building. But you should get a much higher return expectation in a condensed period of time. And so that's what I love for investors is mixing that cash flow component, that longer term, maybe 5-year investment with the 2 to 3 years of a development and be able to get that great mix of diversification and risk return. And I just think those two strategies blend beautifully together as you create a diversified portfolio. Right. And so, a lot of alignment there. Nicely. Yeah, a lot of alignment in how we approach things. So strategy, we understand you're looking at different asset classes and different geographies. And even as you dig in there's different strategies on how to approach different asset classes, right? And then what's the final and maybe arguably most important component of all this?
Well, the last is the sponsor itself. So something I think is not well recognized among newer to intermediate investors is that if you've got a portfolio of rentals that you're running with maybe the assistance of a property manager, you're the sponsor for every single thing. And every sponsor has got some unique strengths and some unique blind spots. And if your entire portfolio is constructed around one blind spot, if something changes, it could really ambush the entire portfolio. So I'll give you an example. We invested, this was like a big mistake that we made, and you can maybe learn from this a little bit. We made an investment, I think it was in Fund 6, with a group that was buying extended stay hotels that were really worn out at a discounted price with the idea of converting them into studio and 1-bedroom apartments in areas where there was an undersupply of that sort of long-term rental product. And they had done renovation value add stuff in the past. They had done management of buildings after they had been renovated in the past. But they had always been larger, more traditional communities of 1, 2, 3, 4-bedroom properties. And they had a property manager relationship that was pretty good for that. When they tried to bring this property manager into some new geographies with a new type of product that was mostly really just studios, it's a different sort of demand because there's no families really in that sort of mix. Mm-hmm. The property manager really struggled And they initially thought, well, it's a new geography, it's a new prototype, we're just going to give them some more time. We've got this long trusted relationship, and it just didn't work out. And they were late to realize it. And since they had a huge established relationship, it was a really painful business divorce for them to go into. And they didn't go into it as fast as they did. And a lot of the projects, they didn't lease up as fast, lease up as well as they would have had we had a, come to reality moment a little faster with the sponsor saying, look, we just need to trade out this property manager. And that was a blind spot. You can imagine if your entire strategy was based on a relationship like that, all of the buildings in your entire portfolio would be suffering in the same way. In our case, that was about 8% of the portfolio, and it was a drag. We didn't do nearly as well as we should have done on that. Fortunately, we had a really great project that offset it. That's how it always ends up working. But having a lot of different viewpoints, a lot of different perspectives, and honestly, a lot of different weak spots that are all diversified, it helps in a very subtle way that people don't tend to think about.
Yeah, I think that's a great thought on looking at different sponsors is there, identifying the specific skill sets and what everybody's good at, right? I think one thing that really resonates with me in the example you gave is, I think people sometimes, if you don't have the experience, expertise, you think about, property management is property management. And it's not.
It's not.
It's not, right? And just like you and I have different skill sets and we're good at different things, property managers and property management companies also have specific skill sets and are good at certain things. Even
Absolutely.
Individuals, the same person that will succeed in managing a C-class property is likely not the same person that would succeed in managing an A-class property. And I think that, and whether it's a student property or it's a conventional, and we've learned a lot of these lessons over time. And a lot of this, are things that
a lot of meetings
kind of just uniquely understand or have recognized, and always thought it was kind of crazy to look at it as a one-stop shop. It's like, no, people are good at certain things. And so I think that that's so important on property management. And I can tell you, we have a similar lesson learned of trying to take a property manager to a new market. Market is highly specific. The relationships in that market, the access to vendors, the deep relationships with contractors and things like that matter so much. And so, that was one reason eventually we actually brought all of our management in-house, was to bring that control and that specificity and focus. But yeah, I mean, that just the idea of understanding the property manager and putting, it's the right tool in the toolkit, right? Sometimes you need a hammer. Sometimes you need a screwdriver. If you try to use a hammer when you need a screwdriver, it's not going to turn out well.
Right.
And so that really resonates with me, and that idea of looking at it from both sponsor, but also who the sponsor is using, and that skill set and alignment throughout their strategy makes a ton of sense. So you want to have many sponsors, as you said, and operating partners with your fund. But when you're looking to pick one, right? Or bring a new, say, hey, I want to work with this operating partner. What are the things that you're using to evaluate if that's a group you want to work with?
We kind of can go through this entire 4-pillar matrix within the individual sponsor. So from an asset class standpoint, let's say it's multifamily. Have you done a lot of multifamily in the past? Can you tell me about some of the projects that you've had that you've gone full cycle on? And then geographically, so it sounds like you guys work in North Florida, South Carolina, and Georgia. Tell me, have you done a lot of projects in those geographies before? What I don't want to hear is that they've been in 15 different states and now they're going to try South Carolina next. I'd really like to hear all of our work has been in just those 3 states, and we're continuing to do those 3 states because we know how the rules work in those states. We know the major markets, the code guys at the zoning departments, and how to get things approved rapidly. We've got deep relationships with all the brokers to get deals off market on the land side. And we've got deep relationships with the guys who be able to sell the product when it's done on the back end. From a strategy standpoint, you want to have someone like, this is probably the most obvious one, but if they're developers, like they've done a lot of development, they haven't done buy and hold for a long time, and now all of a sudden they're going to try a development project. And then brainstorming with them. What are the typical things that tend to go wrong that you've seen on some of your prior projects? What were some of the toolkits, solutions that you brought to solve those problems? Looking at the project that we're talking about investing in now, what different types of problems, in addition to the normal problems, would you anticipate, and how would you go about addressing those if those pop up? Do we have enough contingency, not only in terms of times, but also in terms of money to address those problems? When you go through their budget, there's a confidence interval for every line item in a budget for a development project. Some of those confidence intervals are pretty tight. You don't need to have a lot of contingency on some. Some of them, there's a ton of unknowns. You might need a very broad, amount of contingency. And what I like to do is see contingency like kind of broken out by line item based on the amount of variability that we expect so that we're not blindsided. What I hate is seeing a 4% contingency just as a blanket. It's like, like no thought went into that whatsoever. That should be informed by what they saw on the last 15 projects like that they did. So they're bringing their experience to bear on this budget in a very specific sort of a way. I guess those are some of the things. I could talk about this all day.
Yeah, no, I think those are great. I think you hit on experience, you hit on kind of specificity of focus, right, in certain markets. I think that was one thing I learned early in my real estate career where, you start off and you're like shiny object everywhere, right? It's all these good markets. And what I realized was you can't go deep enough, right? And you really have to pick a focus from a geographic standpoint because some great things you brought up, right? Deep you have to be able to go deep in your relationships from brokers, vendors, contract, all those things we talked about, right? To the city and everybody, it's all about having deep relationships because real estate more than anything else, right? It's an inefficient market. And because it's such an inefficient market, meaning, information isn't always readily available to everyone. It's those relationships that really make the difference. That's how you truly get, off market deals, right? At the deal size we're working at, it's not sending mailers to guys that own 300 unit properties. That just doesn't work. It's the relationships with the brokers who have the relationships with the sellers and being able to really get in there. And so, yeah, I love all
establishing a good reputation with them so that when there's an opportunity, they think of you in the first 5 and you're one of the first 5 calls.
Absolutely.
That sustained performance over time leads to that trust and that leads to the relationship really working in your favor. And that's what you have to really screen for.
100%. Showing the brokers that you're going to perform, right? That you're going to do what you say you do, which is just, important in all aspects of life, but really comes through as you build a relationship there. So yeah, I love it. So just bringing in folks back around to the 4 pillars, right? We hit on asset classes and diversifying across different asset classes, multi, extended stay, industrial. I mean, those are your flavors of choice, right? Geography and the importance to understand the political environment, the the environment related to natural disasters and other things, and being able to diversify across geography. The strategy. So is it value add? Is it new development? Is it core, which is a little more, you're just going to kind of, you're going to kind of take what you get and kind of just be in the lowest risk environment all the way up to development and the highest risk side, but highest return potential. And then the sponsor, right? And you talked about the importance of your fund and diversifying also across sponsors, and some of the reasons that we like to pick the sponsors we like. And so appreciate you for running us through that framework today. I think it's a great way to evaluate investments. Lon, before we let you go, I want to take you through our keys to success round. It's the same 4 questions we ask everybody. And to start that off, the first question is you're well positioned on this one, is if your investor could only ask you one question, or you could only ask the operating partner, the sponsor, one question before making an investment, what is the one question that you say people should ask?
I think the most important question is the management company, because a good manager is like having a great pilot. Like 99% of the time, it doesn't matter if the pilot's great or not, but in the 1% of the time where it does matter, like it matters a lot. It's the difference. A bad manager will wreck an asset. A good manager will save it. It's not a commodity in construction, but it's closer to a commodity. I think there's a lot more variability and subtlety in the management side of it. And the asset's only as good as the manager. So I'd ask them, why this manager? What experience do you have? What do you think that's unique about them?
I completely agree. And it's so fresh for me as we worked over the past year to bring our management in-house for all those reasons. There is nothing more important to the success of a real estate project, especially a multifamily project where you're working with the residents all the time and it's short 1-year leases, then the management, right? I mean, people are going to renew and stay because they like the manager and because they're treated well and because they do what they say they're going to do. And so, yeah, it's absolutely critical. And I think something that obviously falls off the radar of a lot of investors, right?
Yep.
You know, they talk to the sponsor, but
it's easy to gloss over it, just forget about it.
Yeah. Who's the sponsor using in management? Because those are the people day to day touching the customers, right? So it's kind of, amazing when you think about it that way.
There's two other nuances to that too. So you might ask, what is it about this manager that's really important about their skill for problem detection? Because they're the distant early warning system for when things go off track because you're too far away. And then second, what is the problem solving skills once they've identified the problem to fix it? Because there's always going to be problems. It's a question of like, are they going to be big or small problems? And your property manager is the frontline person to address all that. So you want to make sure you have a really robust, your way of looking at all the things the property manager can do for you if they do a good job.
Absolutely. And the faster you get to the problem, you can fix a small problem easily before it becomes a major issue just by that early warning detection and being proactive. And so I love those points. Second question, what are you most proud of in your career?
Gosh, there's a lot of things, but one of my goals for Ironton was to try to create $100 million of wealth generation for our limited partners, and we're well on the way to doing that. And what's great about that is it's not like we're just like creating $100 million for one guy who's going to get like a bigger yacht. Most of these people are entry level, affluent that got a net worth of like $1.5 million or $2.5 million. They've been, an architect that's just really worked their butt off their entire career to save that up. And we're going to be able to either help them retire 3 years faster or retire on schedule with maybe 25% more money. Maybe they've got a dream of sending a kid to an Ivy League school, but they weren't sure they're going to be able to do it. Now they can. Or they've always wanted to buy a beach house for their wife because they had a real interest in that. Now they can do it. I feel like I'm like empowering people's dreams to come true. And it's like, it's the best job on the planet.
I love that, man. I'm smiling because I feel like you're like reading our website or something, but we're very aligned in how we look at that. And I think it truly is something to be proud of to help people create wealth. That's awesome. What is a book that everybody should read?
The single biggest success factor for me has been reading the Wall Street Journal almost every day for 35 years. I've read a lot of great books, but none of them have had the cumulative impact of just spending 20 minutes a day with that. And that's not a direct answer, but honestly, I think that's the biggest impact for me.
It's funny because no one's said that yet on the show in all the recordings. I also read the Wall Street Journal every day and find a ton of value in it. I think just understanding what's going on in the world, and I've become just a maniacal follower of interest rate trends, and it's a great source of that. Yeah. And so, just a great practical resource. So yeah, I appreciate that. Nobody said that yet. All right. Last question. What is your number one key to success?
It's the most boring thing. And it's the key to success, not only for business or tennis or golf or skiing or anything else. And that's just show up. Like Woody Allen said, 90% of success is showing up and do the work and not get bored easily. We'll have to look at 70 to 80 deals to find one that we want to invest in. And we just have to kiss every last frog in the pond to find the princess. And you have to bring the same level of enthusiasm and focus to the 68th deal as you did to the first deal, because it might be number 68 that is the one. And you still have to be like in present to find it.
Yep.
I think it's just the mental stamina to stay consistent. It's not easy to do some days, but honestly, I think that's what separates the people who do great from the people who don't.
Absolutely. There's the quote, I don't remember the exact quote, but it's like, think about how many people stopped like 2 feet from the finish line, is
a lot.
It really is true. Right. And like, that's the interesting about real estate too, is like you said, you could slog through 70, 80, 100, 1,000 deals that we might look at in a year. It only takes one though. It only takes one to be the right deal, to be able to bring forward and create a ton of value. And so I love the idea of persistence and consistency and just showing up. Because like you said, it's more than half the battle, maybe even 90% of the battle.
Yeah, it probably is. Yeah.
Well, Lon, thanks so much for coming on the show today and providing value and walking us through your pillars for diversification. Before we let you go, tell folks how they can reach you. Tell folks, how to get in touch and if they want to reach out and learn more about what you're doing and working on.
Yeah. I wrote a book on passive investing that a lot of your investors might find interesting. And we talk about the 4 pillars in a lot more depth. So you can go to irontoncapital.com/Ritter to get a copy of that for free. It's just Ironton, IRONTON, capital.com/Ritter, and you can get a copy of the book. And you can get a hold of me, Lon Welsh, LONWELSH, so not like the jelly, at irontoncapital.com, or my cell phone is 303-619-0633. I will actually talk to any of you guys. Just text me, set up a time, and I'm happy to get on the phone for 15 minutes about what your strategy is, what you're trying to go to, what are the risk factors, if you thought about this or that or the other thing. I had a lot of people help me out very early in my career, and it made all the difference, and I'm happy to pay it forward and try to help you guys out too.
That's fantastic. We'll make sure all that's in the show notes below, so our folks can go get access to your great book. Appreciate the offer to give it for free. That's very, very nice of you. And so with that, Lon, thanks so much for joining the show. Thanks for bringing so much value and, just living that abundance mindset you clearly are. And so with that,
thank you for having me.
Absolutely. Absolutely. Hope you have a great rest of the day.
You too. We'll talk soon.